Okay, give me a second. Wait. Hey, hi, Lance.
Hey Daniel, nice seeing you. I think
Likewise.
this is the first time we are launching this collaborative project, right? Very happy to be part of this. Um,
Likewise, very excited. I think this is something gonna be very meaningful. I think for the longest of time, a lot of this type of contents is usually either from the founder or from the VC and coming with their own perspective. So I think this is a good chance that um finally we have one where we have both perspective coming together. I
indeed,
think it will be very
indeed.
helpful.
Yeah,
Yeah.
agreed.
So what topic do you have for us today?
I think today it's very much talking about the entire universe of startup investors, right? Under your startup investor ecosystem, you have different kind of groups, right? So
Mm-hmm.
you have your what typically people look at are okay, I've raised $5 million, $10 million, $20 million from this particular venture fund, this particular fund management company, this group of people. Who exactly are they? Right? So today we are going to demystify a little bit about these people and then understand how to approach them in a way that we could really they could really resonate with and potentially um bring
Some
your
of the
startup to the
pitfalls,
next.
perhaps.
Yeah, and of course some of the pitfalls and how they can how they think, right?
Lovely.
Of course this is going to be a very high level topic. We are not
Mhm.
going to delve into the specific details, right? Because
But just as a rough guide, I think it's
Mhm.
at least still some help for startup. Like for example, when I was starting out, the CVCs, there's VCs, there's VB, it took me a while to understand what's the difference, what is the trade-off, when should I go for what. So I think
Mhm.
today's session will be definitely helpful, even if it's just a high level one. Sounds great. Let's
All
get
right,
started.
let's get started. So if you think about a startup investor universe, there are a group of people that when you first start your venture, you probably go to your friends and family, right? You would say,
Mhm,
"Hey, dad, hey, mom, hey, bro, hey, sis, I got this new idea. This is what we intend to do.
mhm.
What do you think?"
Can
Right?
you
Maybe you go to
invest?
a bunch of friends, right, and say,
Yeah.
"Hey, over coffee," and you say, "Hey, guys, I got this great
Mm.
idea. Right? This is what we're gonna do. This is how we're gonna change the world. What do you think?"
The FFF, the friend, family, and fools.
Yes, indeed. So your what I call your FQ, right? Your friends,
Mm.
family, and fools. Some people include the third. I typically just say friends and family, right?
Yes.
Sounds nicer. And
I agree.
these
And I
people,
agree that it's not
Mhm.
just sound nicer. I don't think we are taking them as a fool. I think, or at least most founders don't intend to take them as a fool.
Indeed, indeed. So if you think about your friends and family,
Mhm.
these people invest because of you, right?
Yes.
They invest. Their motivation is to support their friend or their family member.
Mm.
Of course, usually at this stage, it's just an idea, right? We do not know whether the idea could be commercialized in a proper fashion. We do not know whether the idea could even be created into a product that could materialize. It's just an idea, right? People invest because they trust you and they want to support you. Simple as that. Now, you go on to a group of strangers after that. You start building your stuff, right? Then you start going to a group of strangers. These strangers are typically what we call high net worth individuals,
Mhm.
or as some people would like to call them, angel investors, right? Angel investors, or I usually just call them angels.
Mhm.
These angels are a little bit more sophisticated compared to your
Mm-hmm.
friends and family, right? They are usually a couple of different kind of people, right? You have people who have built and sold companies, right?
Mm-hmm.
Your exited founders. So you got a few groups, right? So you have exited founders,
Mm-hmm.
you have executives and MNCs,
Mm-hmm.
right? And then sometimes you get people who run fund management companies. So you have your fund managers. But in general, angels typically invest in their personal capacities.
Meaning they are using their own funds
Indeed.
instead of a VC who actually raise their funds from
Mm-hmm.
investors.
Mm-hmm.
I think while we are on the topic of angels, I think it's also interesting to point out to the audience that Lance is the chairman of Bansi. Maybe you can maybe take this time to share also a little
Sure.
bit about Bansi, what it's about, and how it supports startup.
Mm-hmm. Sure. So what we will, so I will just jump over to my next screen.
Mm-hmm.
So what we do is essentially what we call an angel group, an angel alliance, an angel network, or some people call it an angel syndicate. So what
Mm-hmm.
happens in this case is you have a group of angels. We have
Mm-hmm.
more than 40 angels in our active membership, more than um, and we have been established since 2001. So
Mm-hmm.
what essentially Bansi does is we bring together
Mm-hmm.
your angels,
Mm-hmm.
we link them up to
Mm-hmm.
potential startups that they could invest in,
Mm-hmm. Mm-hmm.
right? In the past, startups have to pitch to angels on a one-on-one basis, right?
Yes, very
So it's
tiring. Having been through it myself, it's a very, very long process.
indeed, indeed, it could be a very tiring process as well because just imagine trying to repeat the same concept over and over and over and over again to a bunch
Yes.
of people.
Mm-hmm.
So what we are saying is, you know what? Let's make this
Mm-hmm.
a little bit more systemized, right? So instead of you pitching once the founder pitching to one angel,
10 times, you pitch to 10 angels together.
yeah. So let's say you got three angels here. So what we
Mm-hmm.
do is we are saying,
Mm-hmm.
let's pull them together in one place. You pitch to them at one go. So it makes
That
it more
sounds.
efficient, right? It's way more efficient that way.
Mm-hmm.
Um, on top of that, the angels can also learn from each other because we all come from very different backgrounds,
Mm-hmm.
right? Sometimes I may not understand fintech, but I'm sure there will be someone in the group that understands fintech. So I'll go to
Mm-hmm.
him. If I have a
Mm-hmm.
fintech deal on hand, I'll go to him and I say, hey,
Mm-hmm.
I got a fintech deal on hand. Not too sure how to evaluate this. I
Mm-hmm.
just want to hear your thoughts, right?
Mm-hmm.
Expertise sharing,
Mm-hmm.
right? And then sometimes what we can do is we say, hey guys, angel investing requires diversification. And because the failure rates of startups are very high,
Mm-hmm.
the research has shown that 30 only 10% of startups survive beyond 3 years,
Mm-hmm.
right? Only 5% survive past 5 years. So if you want to pick your winners, sometimes it may make sense for you to spread your bets a little bit more. So in certain cases, we will do something called syndication, right? So in the case of syndication, what happens is instead of, let's say you got 20 angels who are interested to invest in your company. In Singapore law, at least, there is a limit to the number of shareholders that you can have as a private limited company. So what we say is, you know what? You deal with one of us.
Mhm.
We will deal with the rest of them. Let's say you've got
Mm.
21 angels, right?
Mm.
Yeah, then one of the lead angel will come in and say, you know what, you deal with me. I'll deal with the
Mm.
other 20 guys, right? We'll create a private limited company and
Mhm.
we'll use that as our holding company to invest in your startup.
Mm. That sounds a lot efficient for,
Indeed.
well, imagine if I'm
Yeah.
an investor and I have to update all of them. I think that can be very, very, very
Mhm.
tiring. But what about some of the downside to talking to individuals, angels versus a syndicate?
I think for individual angels, sometimes the good thing is they actually, uh, most of them can at least make decisions pretty fast. When you're
Mm.
dealing with a syndicate, you probably are talking to a bunch of people, right? So if you
Mm.
think about venture funds, you
Mm.
go through the analyst goes to the partner meets you, and then you have a whole conversation, and then there's a lot of ding dong, and then eventually you make it to the investment committee, you pitch to the investment committee asks you questions, there's another bunch of ding dong, the
Mm.
investment committee votes, then and only then the money comes in.
So you're saying that the trade-off being is talking to a syndicate is efficient for the long run because you don't have to talk to 10 of your investor, update them. You just need to update one person. However,
Yep.
at the beginning, because there's a bunch of them, they need to come together to make a decision. It can be a little bit more slower.
Yes. So and on
Mm-hmm.
top of that, when you syndicate, because your
Mm-hmm.
check sizes are much larger now, right? So usually
Mm-hmm.
angels typically write checks between, I've seen anywhere as small as 10K all the way up to 250,000.
Mm-hmm.
A syndicate could easily write 500K
So
if
that's
done right,
another advantage of having a
right?
syndicate.
But what that also means for the investor
Mm-hmm.
is now because I have a much bigger pool of money behind me, I have a lot
Mm-hmm.
more negotiation power.
Mm.
So now I could come to you and say, in the past, I couldn't get a board seat. In the past, I couldn't dictate certain terms. Today, because your round is, let's say, 600, I'm filling 500,
Uh-huh.
I will come and tell you, hey, your valuation is not going to cut it.
Because you're the
Your
majority.
your terms are not going to cut it. Here's my terms. What do you think?
Okay,
Right.
that's interesting. I have spoken to multiple angels before. I have multiple angels wanting to invest in my startup before. I've never spoke to a syndicate before. I think this is a very good takeaway for our audience. So, dear audience, if you are a startup, you are talking to angels, depending on the speed, if I understood Lance correctly, depending on the type of negotiation power you want to give them, and also depending on whether you want it to be more efficient at the front versus in the future. I think that will give you some
Yep.
idea on whether you want to approach individual angel or syndicate angel. Am I correct?
Yes, indeed. So just
Okay.
remember, syndicates slower at the start, a lot more efficient when it comes to the cap table. For individuals, typically quite fast at the start, but then at the end, you may need to create a SPV to house all their shares and then put them on the SPV instead. So these are trade-offs that you need to think about when you're doing fundraising.
Yeah,
Right?
I did actually had an angel who spoke to me on the same day and was prepared because his lawyer, he happens to be an M&A lawyer, he was prepared to actually even write a check and sign the deal on the same day that I pitched my idea to him.
Wow, that's nice.
That is indeed how fast it can be. Yeah, yeah. So what other type of investor are there in the startup world?
So as
So far
time
we cover,
progresses,
yeah.
you have your angel syndicates, your after your friends
Mm-hmm,
and family, right? These guys start
mm-hmm,
investing their own money. Now
mm-hmm.
you come to your a point of, some people say, the point of no return. Uh, I don't like to use that term, but some people call it the point of no return. And the reason behind that is because now you're talking to fund managers.
Mm-hmm,
And fund managers are essentially fiduciaries.
mm,
Most of them raise capital from external investors,
mm-hmm,
right? So if you think about, let's say, in your, some people call that Series A, right?
mm-hmm,
You're looking at venture capitalists,
mm-hmm.
right? Or in short, we like to call them VCs.
Mm.
These guys don't invest it, or most of them don't, or at least majority of the money doesn't come from them.
Mm,
Majority of the money comes from their investors that they
mm,
need to account to. So now you are starting to see due diligence actually kicking up a notch.
mm,
The the things that they examine, the things that they drill deeper on,
mm,
these are questions that you probably would not have encountered with angels. So now,
mm,
if you talk about a financial model, the angel may say, okay, let's take a look at your financial model. Let's understand a little bit of your assumptions. Do they match?
mm,
Right? And are your assumptions are your assumptions reasonable?
mm,
Most of the time, if you clear these two criteria, you'll be
mm,
quite okay. A VC would drill deep and say, I noticed some irregularities in this particular part of your financial model. Let's
mhm,
say your cash flow, right? You talk about free
mm,
cash flow.
mhm,
I noticed some irregularities in this capex. There's a spike here in your capex. Can you explain to me
mm,
what you are projecting in terms of why you're spending this money on this particular area? They will start drilling into these kind of things.
mm,
Um, and you need to be prepared for that.
mm.
Typically, the
Oh,
VC due diligence cycle takes about 3 to 6 months. So,
and also, by the way, for the audience, subsequently we will have a session on the lexicon of the VC world, so things like LP, capex, things like that. So we will go into them. So remember,
mhm,
stay tuned.
indeed. So, as we have an episode coming up on that,
Mhm,
so I won't delve into how a VC fund works.
mhm,
What I would just do is I will just give a quick overview on
mhm,
how VCs think, and
mhm,
maybe a little bit about why they do certain things in certain ways.
mm, mm,
Firstly, these guys take about, let's say, these guys are what we call institutional investors.
mhm,
So what that means is they invest as their primary career,
mm,
right? As their primary source of income. Number two, these guys would take their due diligence compared to angels, right? The due diligence period for a venture capitalist would be somewhere around 3 to 6 months.
Wow, that's really, really long.
So what that means is you want to prepare when you approach these guys, you want to
Mm,
prepare at least 6 to 9 months worth of
mhm,
runway.
mm. So that you don't end up in a situation where you run out of money before they can decide.
Correct. So they would look at your financials quite deeply. They would look at your business model, revenue model. So usually by this stage, you would be already revenue generating for most companies.
I think maybe I can also like to take this time to highlight to the audience that this is the average. Of course, it's still subjected to each VC how they work. There are
Mhm.
definitely some who can get back to us faster. There are definitely some who also invest at the pre-seed stage, at the proof of
Indeed.
concept stage or
Pre-revenue.
revenue generating.
Yeah. But this is typically what we notice, at least in the Southeast Asian markets.
The
The
general, the
your
average.
average VC, right, that is
Okay.
trying to generate 20% IR, internal rate of return on
Mm,
capital to their investors, right? In Southeast Asia, most of them do software deals. Most of them do particular kind of deals that they're familiar with, right? So
mm.
you're talking to people. So some people do B2B, some people do B2C, some people do both, some people do purely software, some do hardware. It
Some
really
do
depends.
fintech,
Yeah,
some
indeed.
do construction, some do
Yeah.
agtech, some do proptech. Yeah.
So if you think about that whole spectrum
Mm,
of people,
mm,
these guys are actually quite diverse. So my suggestion before approaching a VC is you need to
mhm,
understand. their investment mandate.
Or TCs.
Yep. So if you think about the investment mandate, right? If you are let's say you are a fintech company,
Mm.
would you go to a fund that focuses on fintech, or would you go to a fund? You have three options here, right? One, go to a fund that focuses on fintech. Second, go to a fund that invests in anything and everything.
Mm.
Number three, go to a fund that invests purely outside of fintech. Let's say just construction technology,
Mm.
right? You probably want to go for the first if you have
Mm.
the option,
Okay.
because they have industry experience, they have the industry connections that you probably need.
Mhm.
You may go to the second group of people because they could give you, they will probably at least take a look and see whether you could be a potential portfolio company in their fund.
Mhm.
But you probably will not go to the third guy.
Yeah, because they probably wouldn't invest. It's just wasting my time and their time.
Indeed. So you need to understand the investment mandate. And I think the best way to
Mm.
do that is to understand what portfolio companies they have.
Mm.
Look at it, see what are the trends, right? There are some funds that purely do B2C.
Mm.
There are some funds that love B2B deals.
Mm.
There are some funds that purely do fintech. There are some funds that do purely decarbonization. And then you have your funds that do everything and anything, right? So you
Mm.
want to understand a little bit more about what are their inclinations before you approach them,
Mm. Mm.
right? So back to the main topic, right? You are usually revenue generating. You are
Mhm.
looking to, you probably have 2 markets to 3 markets, hopefully. Hopefully 2 to 3 markets,
Mm.
right? Hopefully. 2 to 3 markets. And you're raising to scale, raising capital to scale.
What about CVC, VB?
Ah, so if you think about VCs, their
Mm-hmm.
main the reason why we call them institutional investors is because they mainly invest for returns,
Mm.
right? If you think about your CVCs, right? So you have CVCs, or it's essentially corporate venture capital. Corporate VCs typically, most of the time, they invest for strategic reasons. So for example, if you think about an MNC, like let's say Bentley Systems, these guys are doing focus on around technology in the construction sector, right? And they do things, they are looking for technologies like digital twins
Mm.
to complement their suite of solutions to their customers. So if you are not if you're not an AI or digital twin player in the construction sector, they probably would not invest, even though
Mm.
it could potentially make them a lot of money, because they are looking at it from a very strategic angle. And sometimes it's good to have them, sometimes not so much, right?
Because they
Because
may put their own agenda first over
yes,
the startup.
so we have seen certain CVCs, I don't want to name
Mm.
names,
Mm-hmm.
making startups sign a certain exclusivity agreement in terms of distribution with them.
And that may actually limit the startup ability to grow.
Indeed. So it becomes a case where you could only have one channel partner. But I think from the CVC's perspective, it's
Mm-hmm.
not so much on the returns, right? Because if they want the returns, they would never ask them to sign an exclusivity agreement.
Mm.
but I think it's from a strategic standpoint. They want an edge over their competitors. So you have these kind of things going on with certain CVCs, not all, but we also notice that sometimes corporate VCs actually take positions with the institutional guys. So they are saying
Meaning?
they invest into the institutional fund and let the institutional managers make the decisions.
Mm-hmm.
Along the way, they will monitor the portfolio and then ask for introductions through the institutional fund managers.
So in this type of case, they are trying to grow their money. They are not looking, they are more like an investor rather than a CVC. But at the same time, they also are making for the opportunity to discover a company that might be able to add on to their offering and for them to strengthen their positioning over their competitor. Is that what you're
Indeed,
saying?
this is this is a good way of looking at it. Some of them say they want to get the institutional guys to help them look for potential innovations in their industry. That could be another reason, right? They
Mm-hmm.
could say, okay, um, we want to look for innovation at scale.
Mm-hmm.
Our venture team can't do it alone. So
Mm-hmm.
let's engage the institutional guys who are doing this on a full-time basis,
Mm-hmm.
right? And then we focus on what we do best.
Mm-hmm.
We partner when there's an opportunity. And
Mm-hmm.
then other than that, get the institutional guys, let them make us money, make us some money. Along
Mm-hmm.
the way, if there are opportunities to collaborate with the portfolio,
Mm-hmm.
get them to introduce to us. We'll see how we can partner. So I think
Mm,
different people have different agenda,
mm,
right? And then following on to the corporate VCs, you have another group of people which I think are
mm,
quite interesting these days, especially
mhm,
what we see Singapore trying to do.
mhm,
These guys are what we call family offices.
mhm,
So family offices are you can think of them like investment vehicles for the rich,
mm.
right? Remember we talked a little bit about angels earlier.
Their own personal private banker.
Mm-hmm. So what family offices that we, at least in the last couple of years, we have seen a growth in the number of family offices within
Mhm,
Singapore.
mhm,
Hong Kong is a very big hub for family offices as well.
mhm, mhm,
So now we are seeing that kind of the rich coming out and say, okay, maybe let's deploy a little bit of capital in venture. But
mhm,
do note that the family offices, they have a mandate for what we call capital preservation. So capital preservation, so for venture capital, you are looking at more of capital growth, right? That's why
mhm,
you hear a lot of the VCs asking themselves when they look at a startup, can I 10x this in the next 3 years?
mm,
Family offices don't go for that. They say, okay,
mm,
can I grow my wealth that
mm,
in a way that beats inflation
mm,
while keeping my existing business or my existing portfolio growing in the long run.
mm,
So these guys have very different mindsets,
mm,
and but what we are starting to see is they're acting a little bit of a mixture between the VCs and the corporate VCs, where they're saying,
mhm,
okay, maybe I deploy some capital into startups that could add to my existing businesses,
mhm,
right? So we see these kind of dynamics coming along. Um, and usually for the VCs, these guys usually have an exit. The VCs usually have an exit timeline. So by let's say 5 years, I need
mm,
to sell my position.
mm.
As to why, it's
Does they need to
relate
generate a return?
it's related. Number one, they need to generate a return. Number two, is also
Mhm,
related to how the funds are being managed. Uh,
mm,
Most funds are 10 years, last for 10 years. So what
mhm,
it means is you need to deploy capital.
mhm,
grow the assets under your portfolio, and
Mhm.
harvest, meaning sell off your assets to generate a good return within 10 years, right?
Mhm.
This is how most funds are being structured. We'll talk about
Mhm.
that in a separate episode focusing purely on VCs. But when you look at these people, they are going for that kind of
Mhm.
time horizon. So you need to keep that in mind when you take that money,
Mhm.
right? So for VCs, the key question here also is time horizon. You
I
may
think you
want.
make a very, very good point here. I think a
Mhm.
lot of founders that I have spoken with, they think money is just money, but I think some money are a little bit more worth it than the other. Like for example, there was a pitching contest, and just the night before the pitching contest, I decided to drop out, even though I was selected. When I realized that there was a CVC, and if I were to win the pitching contest, the equity I had to give up was double of if I had taken part in the normal period. But I don't necessarily get more. So I think this is also to do with what you mentioned about the corporate CVC. They work with a VC for that strategic reason to discover any startup that they can invest in to give their edge to the core business. However, I think in some case, uh, the vice versa, that there don't necessarily be a benefit to the startup, and I
Mhm.
think startup should look at not all money being equal, and to just also take note of what Lance has mentioned, and when thinking about the suitable type of investor to speak to, take that into consideration.
Indeed. So for the time horizon, usually
Mm-hmm.
that's why you usually in term sheets, sometimes you see terms along the lines of mean we have the option but not obligation to sell our assets after 5 years
Mm,
to
mm,
subject to the necessary terms and conditions as per a
mm,
typical shareholders agreement.
mm,
The idea is
mm,
I need to get out to return money
mm.
to my investors.
So back to family office, does that mean that because they are more on capital preservation, they don't have this? And what does it mean for a startup or a founder?
I think for family offices,
Mhm,
the they do allocate some money to venture,
mhm,
but from what I have seen so far, most of the capital is not allocated into venture for
mm,
reasons around capital preservation and the nature of
mhm,
venture itself. Because if you
mhm,
think about venture, you
mhm.
are looking at a failure rate of more than 90% most of the
It's
time.
a very high risk, high return thing.
Indeed. But of course, if you hit a good one, you could get sometimes 100 times. So, but
Or like Uber, in the first year to, I think prior to the IPO, it was 18,000 times. But of
mhm,
course, knowing the correct time to sell is also
it's
another
key,
part of it. Yes.
right? So for family offices, they want to make sure that the portfolio doesn't have that kind of volatility, right? Um, so they would say if you're able to give me 8% on a stable basis, 10% on a stable basis, that's good enough.
Mhm,
But because most family offices have
mhm,
huge amounts of capital, 8 to 10%
mhm,
is pretty significant if you
mhm,
think about it. It's actually pretty significant. So
mhm,
for them, what we see is they like to do a lot of deals around real estate. They like to do deals around a little bit the companies that they usually invest in tend to be a little bit more mature,
mhm,
right? Of course, you do see some of them invest a little bit here and there in startups, a little bit here and there in venture funds, but part of the capital is usually in public markets,
mhm,
real assets that we see. Sometimes you see art for hedging reasons,
mhm,
but they have certain ways of so that their mindset is a little bit different compared
mhm,
to your VCs.
And even if they invest in startup, they typically do it through a VC. So family office is not a category of investor that startup need to start knocking on their door.
At least at a very early stage.
Mm.
Unless you know for a fact that this particular family in this happens to be in this particular business and you really want to get into that business, and you are maybe in the industry and you are adjacent to that, you have a product line adjacent to theirs, then
Mhm.
maybe that could be something that you want to look into, right? But you
I,
would think of it like a CVC.
and I think there's one last category, correct? Venture builders.
Mm-hmm. So venture builders are an interesting breed of people,
Mhm.
right? So if you think about the venture builders,
Mhm.
sometimes we hear terms along the lines of incubators. You hear terms around the lines of accelerators, right? These guys are a little bit similar.
Mm.
If you ask me, I would just split it down this way. And
I
there's
agree.
I will split it down this way, right? For venture builders, what happened is they don't they most of the time they don't take in ideas from external. So if you have already formed an idea and all that, you typically don't go to a venture builder, right? So these guys typically what they do is they use internal ideas, right? So
Mhm.
internal ideas,
For your likes of Stanchart Ventures,
indeed,
SCV,
SE Ventures,
or
you
BCG Startup X.
you have a lot of then you have the various commercial venture builders like Origin and a few others. So what they do is they take internal ideas or they work with like universities, research institutions, and they take intellectual property from these places. They spin it off into startups, commercial startups, looking at particular problems to solve, but
Mhm.
they are mainly internal, right? So they
Mm.
usually have an internal team of founders, right? And then they provide some, let's say, some shared services. For example, product development, maybe a little bit of marketing and sales here and there, um, on top of the capital that they provide, the initial capital, right? Of course, initial capital. Unfortunately, most venture builders take a very big chunk of equity. I've
Because
seen as high as
uh,
50%.
wow, that's a lot. But then again, their justification is also because they provide certain help
Mhm.
in a certain way. They are beyond just an investor, they are also to a certain degree acting as a co-founder.
Yes. So, one of the, if I may say,
Mhm.
more prominent venture builders in
Mhm.
Singapore, if you ask me,
Mhm.
is this company called
Mhm.
Trendlines.
Mhm.
Trendlines is actually listed on the Singapore Stock Exchange.
Mhm.
So if you are interested, you can take a look at their shares. Not trying to market any securities here, by the way, just to be clear, right? But Trendlines is an interesting model because what they do is in the agri-tech, food tech, medical device, biotech space. They
Mhm.
work with founders in Singapore, they work with founders in Israel, and
Mhm.
they take technologies from the research institutions, they spin it out as a potential idea, as a potential startup.
Mhm.
They work with them,
Mhm.
they take about 50% if I'm not wrong. And then along the way, they will continue funding the startup from
And
time
I
to
think sometimes that's also fair. Of course, not every instance, but
time. Mm-hmm.
generally the concept is also fair because I think sometimes they have that distribution
Mm-hmm.
network that can really help propel
Yeah,
the startup a lot faster. So it maybe it really make the pie way bigger that even if you give up
indeed.
50%, it might be justifiable. But definitely it sounded like something that there is definitely a lot more consideration because of
Mm-hmm.
equity they take is a lot more than your VCs.
Mm-hmm. So I
What
think
about EQ?
so I think for venture builders, it's for founders if you have you have sort of an idea that you want to go into
Mm-hmm.
this space, you're trying to find an
Mm-hmm.
idea to really work on, you can potentially have
Mm-hmm.
approached these guys, right?
Mm-hmm.
They will say, okay, I have let's say 20 ideas.
Mm-hmm.
Pick the one that resonates with you most and tell me why,
Mm-hmm.
right? For
Mm-hmm.
example. So some people call them startup studios, some people call them venture builders. You hear all kinds of terms. People use all kinds of terms for all kinds of things. So
Yes.
I will leave
And
it as
I
that.
believe there are also venture builders that don't just do internal ideas.
Mm-hmm.
They don't necessarily belong to a corporate like SEV,
Mm-hmm.
but they are a VC, just that they like to provide beyond just money.
Mm-hmm. There are instances of that. So what we are saying is a an inst they act like VCs, but they also have an operational arm that you see their operating partners going
Mm,
in and say, hey, can I open up doors for you to some of these MNCs that
mm,
I know could be your potential clients, right? So
mm.
you start seeing that kind of situation. So I think now a lot of these lines are getting blurred,
Yes.
right? You start seeing corporate VCs acting like VCs. Give you two examples. Coming up from Google. Google has three CVCs actually.
Oh.
They have their corporate development division. So that
Mhm.
is the CVC model where they invest purely to gain a strategic edge over their
Mm,
competitors. They have this arm called GV, formerly called
mhm,
Google Ventures.
mhm,
These guys are doing early stage stuff.
mhm,
Um, they act a little bit like venture builder, they act a little bit like your Series A VCs, your early stage VCs. And then you have the late stage guys, which is called Capital G. Now they call it Capital
mhm,
G. In the past, it was Google Capital. We'll touch a little bit on their model later, but you can think of GV and Capital G as pretty much institutional kind of investments. Just that they have
mm,
Google as their backer. They
mm,
you if they invest in you, you probably have some of the teams in Google behind you to support you
mhm,
along the way as well. So
mhm,
I think you're starting to see some lines being blurred, right? And then you talk about SoftBank.
mm,
It started as a software distribution house. They started to invest here and there like a CVC,
mhm,
with the idea of returns, which
mhm,
a little bit like a VC. And then they
mhm,
started raising capital from external investors.
mhm,
Just look at what happened in the Vision Fund, right? They
mhm,
raised money from Saudi Arabia. They raised money from Abu
mhm,
Dhabi. They raised money
mhm.
from Apple, Foxconn, and all these guys. So are they actually CVCs? Are they VCs? Are they venture builders? Are they, the lines are getting blurred, right? And then you have a bunch of people called the incubators and accelerators, right? Which
Mhm.
we're gonna talk about. So these guys are also a
Like your
little bit,
accelerating Asia, like
uh-huh.
your Endler.
Yep. You even have in the past you have your entrepreneur first who have exited Singapore. These guys focus on
OCBC Vault.
mm-hmm. So you will be FinLab, right? So accelerators and incubators, I think some of them take equity, some of them don't, right? Very another bunch of different kind of animal, right? So you have some take equity, some don't. So some of them invest, some of them don't invest, right? You sometimes see like even if you think about the incubators in the universities,
Mhm,
right? Like your NUS Enterprise, Intuitive, uh, you have SMU IIE, you have all these different guys. They're kind of like incubators slash accelerators. And then you have a commercial accelerators like Accelerating Asia, like you mentioned, right? Accelerating Asia, Ansler, Y Combinator, and these guys. And then you have then these guys also take different stages, right? So if you think about it, these are usually either pre-idea. So some cases are pre-idea. So if you think about Antler,
Mm-hmm.
right? You think about then EF, most of them are pre-idea, right? You
Yes.
form your idea after you join the incubator program.
Or
And
you have an idea, but your idea
then,
will change along the way depending on
indeed,
who you match up with.
yep. So you to maybe a MVP stage. So
Mm-hmm.
minimum viable product, right? So if you think about accelerating Asia, you have a minimum viable product. You probably are selling a little bit to some people. They work with you to expand your reach to more um to more investors, to more customers, to more potential vendors, partners that you can work with. That's accelerating Asia. You have people like SOSV who do the same thing. So if you think about, and then some of these guys, right, like accelerating Asia, SOSV, these guys are also VCs.
Yes. I noticed, like for example, Techstar,
Mm-hmm.
if you are of a certain stage, sure you
Mm-hmm.
can speak to their VC, but if you are a little bit too early, then they'll send you their accelerator. I
Yeah.
guess is a way for them to expand
Mm-hmm.
on their deal flow, even if they can't deal with someone or invest in someone yet, they would like to keep them in their circle through
Mm-hmm.
this program, and from there to get them to ready or to be at least a stage where it's probably easier to consider the investment on them.
Yeah. So we are starting to see some accelerators at one point. They were popping up here and there. Um, Sequoia India, now known as
Mhm.
P15 Partners, actually runs an accelerator called the Search program. And then Sequoia US started doing this ARC program. So these are accelerator programs by Sequoia, right? They have a dedicated fund for it. And then if you manage to clear the accelerator and then you hit certain milestones, they get the main fund to invest.
Mm.
So you can think of their accelerator funds as a scout fund for their main funds to come in later, right? To say, okay, I see a potential in your company. I think it can potentially grow even bigger. Unfortunately, my mandate is to invest only maximum, let's say $3 million, for example. I know you need 20 million. I can underwrite 15 million if you can convince my VC arm to write you a $50 million check, because that's our check size at the VC level. So you start seeing these kind of situations within VCs, right? You start seeing VCs opening up accelerator programs. You start seeing accelerators that didn't used to run a venture fund starting to raise a venture fund and
Mm.
using the accelerator as one of their quote unquote proprietary deal flow
Mm.
sources. So you're starting to see a lot of these lines being blurred, right? And then you
A
have,
lot of overlapping in each other territory.
yes. So you talk about even later
Mhm.
when we talk about private equity, we talk about hedge funds, you
Mm.
start seeing a whole overlap between the VCs and then the CVCs coming in somewhere. You start seeing hedge funds
Mm.
coming into the scene. You start seeing
Mm.
private equity coming downwards. You start seeing VCs going upwards, right? You see these lines are being blurred. But I think the way they think is very different.
Mm.
So I split them by the way they think,
Okay.
right? PE, I won't go too in depth
Mhm.
because they have different models, right? So if they have different models, right? Private equity has different models. You have your leverage
Mm.
buyouts, you have
Mm.
growth
Your
equity,
M&A.
right? And then eventually, hopefully one day,
Mhm.
if your startup becomes big enough,
Mhm.
you would undergo sometimes people would do different kinds of rounds, right? So they will go for PE.
Mhm. Mhm.
Some people go for PE, private
Mhm.
equity. So in private
Mhm.
equity, most people they are going for what we call growth capital.
Mhm.
So growth capital, or some people call it growth equity. And sometimes, if you're already profitable, very profitable, what you may see, this is not as likely, but what you may see is what we call a leverage buyout. So this is where you start seeing your M&As coming in, right? So for PE, it's a leverage buyout for your corporations. Remember we talked about CVCs earlier, right? So we sometimes see corporations. You start seeing what we call mergers and acquisitions, right? That's when you say, okay, great, we have an exit, right? You have an exit here, right? You can say, okay, great, we have an exit, right? So what happens here is most of the time you sell 100% of a company to someone.
But not always, correct? Sometimes you can just talk to them as an investor and they take just a certain percentage of equity.
Yes. But most of the time when we say an exit, you are looking at least 51%. So you're selling at least 51% of your company away in one series of transactions. Right? So this is usually an exit. Another form of exit, if you manage to hit that point, is to go on the public markets through a process called an initial public offering, right? Or IPO. Recently, Reddit just IPO'd. I'm not sure how many of us here use Reddit.
Right? Our first homegrown ride hailing.
Grab, right? So you talk about Grab. You talk about Property Guru, right? You talk about your much earlier, you have the C Group, right? Which basically runs your Shopee, your Garena, for our gamers here. And now they have Marybank, which is under their fintech arm, right? So C Group, you have Grab, you have Property Guru. These have all listed on the markets. So now if you go to any of your brokers, right? If you are working with any of your brokers, you can go to them and say, okay, and if you have the ability to trade US shares, you can say, hey, I want to buy 100 shares of Grab, or I want to buy 100 shares of Property Guru, or I want to buy 100 shares of C, right? It's public, right? That's why it's called an initial public offering.
So in other words, IPO is also a fundraising event, but rather than to a specific company or institutional VC or angel, you are actually through the public raising funds from them.
Yes. So you are offering your shares to the public for fundraising, fundraising activity for the first time, right? So this is usually done by so you usually price it and all that through an investment bank, right? So your people like Goldman Sachs, Credit Agricole, JP Morgan, Morgan Stanley, these would be the guys who usually say, okay, I will take, let's say, a certain percentage of your entire offering. Right? Usually this would be in the hundreds of millions. And then I'll distribute it for you. Of course, for a fee. Right? So this is also a good chance where you start seeing your angels, your VCs, maybe for certain cases, your CVCs, family offices, private equity guys, etc., etc. You start to them. This is also an exit event. Right? Because now I can sell my shares to the public. I don't have to hold it on my books as an illiquid asset. I have turned essentially an exit. The idea of an exit is I turn an illiquid asset into a liquid asset.
So they can also return the cash, invest in new startup, repeat the cycle.
Yeah.
That's very, very interesting. So today you have shared a number of different type of investors. So do you think you can just give us a summary and to also help our audience understand, probably at what stage they should talk to which type?
Sure. So what I would do is maybe I would draw a particular diagram to illustrate this. So you got time on this axis, and then you have, let's see, revenue, let's say revenue or profit or whatever on so basically money on this axis, right? The money that you generate as a startup, right? Not from fundraising activities, but from operating activities.
More often than not, at least.
Right. So I would usually draw it this way. Right. So there's a particular J curve effect there before it starts to plateau off. Usually at this early stage here, of course, remember there will always be overlaps. So I would just give a rough understanding. So this is where you go for your family and friends, right? And then I would say maybe a little bit after that, you have maybe your angels. Your angels meaning both individual angels and angel syndicates. You may start seeing some VCs coming in around this area. Let's see. Let me draw that. There's an overlap here. Let's say. So you start seeing VCs, right? And then along the way, you start seeing, let's say, some CVCs coming along the way here and there. Then you have some CVCs here. And then I would say you probably, along the way, anywhere along this cycle, you could potentially get an M&A offer, right? Just at what valuation? How do we calculate valuations? We'll share it in another session.
Yes.
Right? So CVCs, sometimes you have family offices, private equity guys along the way. So you bring in the private equity somewhere here. Oops. Private equity guys. Private equity. And then some of them, the family offices. In some cases, family offices. Family offices. Right? Depending on how strategic you are to their business. Right? And then of course, if you make it all the way, you have an initial public offering somewhere here.
I think that's the top thing that most founder are looking forward to.
I think it's a good milestone to have, but I just want to remind founders that IPO for you is not an exit. It's a beginning of a new phase. Right? What happens is most founders see IPO as the end goal. Right? I think what we need to understand is IPO is a transition phase where you go from a private company to a public company. Right? This is a very important, this is a very big transition, right? It's a very significant transition for you and your investors because now your shares are being publicly traded. But do know that sometimes your priorities could change, right?
Yes, because to the public, them being your stakeholder, you're answerable to a different group of
Yes.
people right now.
So now you have a lot more at stake, right? You are now saying, okay, in the past, I just have to answer to me plus 30 investors and employees and my co-founder. Maximum maybe 40 plus people, right? Now you have to answer to probably a few hundred people.
Maybe even thousand, and not to mention the general public has scrutinized everything you do, your financial
Yes.
statement and whatsoever.
Yeah. So just remember it's the beginning, it's not the end. Right. So I think that's an important takeaway that that I think founders need to understand. Yeah.
Very true. Very true. Very true. So in a nutshell, everyone, so this is what we have prepared for you today. We hope you enjoy it. The next session we'll be talking about a safe note. A safe note is another, so today we have talked about the various type of investor you can talk to. What's next is also how the investment can be carried out, safe note being one of them. So Lance will be sharing about the various type of safe note out there, the pros and cons of a safe note. So remember to stay tuned.
Looking forward to that session. I look forward to hearing your questions. If you have any questions, feel free to reach out to us. Right?
Yes,
We
we'll be
will
posting a
come.
Google form together with today's recording and post. So any questions, burning questions that you would like us to ensure that will be asked and answered, to leave us the questions in the Google form.
All right. Till next time, take care, stay safe, and all the
Thanks,
best for
Lance.
your startups.
Thanks, everyone.
Take
Bye-bye.
care. Bye.